Hey, everybody. Today is Friday, December 15th. And the reason I'm telling you that date is on Wednesday, there was a fairly significant meeting of the Fed, and there were some announcements made that kind of sent the markets into a tailspin, and rates started dropping fairly quickly. In fact, the headline last night was that we haven't seen this big of a 2-day rate drop in the history that rates have been tracked. So, what does that mean for you as a buyer? What does that mean for your mortgage payment? And how do we strategize to make sure that you're getting your offers considered as the market starts to heat back up again? So let's just take a look here real quick on this mortgage coach. Using a purchase price of right around $280,000, which I think is a reasonable number to consider as an average first-time homebuyer purchase price in the area that we're in. And let's just pretend that rates might have dropped by 1%. So let's say we went from the mid-sevens down to the mid-sixes. That's going to create what we call an affordability gap of about $180 a month. So the question then becomes, do we use that $180 to our advantage to save money on our mortgage every month? Or do we use that $180 to increase the purchase price in the homes that we're looking at? And those are both really good questions, something that you're going to want to talk to your real estate agent about and certainly talk to your lender about. But you can see that interest rates dropping by up to 1% frees up about $180 a month on an average purchase price of $280,000, where we're most likely putting down 3% as a normal first-time home buyer. Let's scroll down a little bit further. Let's pretend that you could put these properties side by side and they were both settling at the same time. So we have the exact same purchase price, we have the exact same loan amount, but we have two very different interest rates. You can see that the monthly payment obviously is about $183 less, with the prevailing interest rates being about a percent lower. But look over the first 4 years of the loan. So over the first 48 months, you can see that 1% in an interest rate decrease saves the buyer about $11,000 in interest over the life of the loan. Over the first 48 months. I'm getting confused here. Let's scroll down a little bit further and see what happens if these loans would pan out over a 7-year period. How much interest and mortgage insurance is paid. And now you can start to see a little bit more of a gap, about $20,000. Most importantly, that lower interest rate is going to put you in a position to have slightly more equity in that same 7-year period of about $4,000 more. Your loan balance is about $4,000 less. And the total interest and mortgage insurance you paid is about $20,000 difference. So a couple things are going to happen here. If rates continue to drop, you're going to see more people get back into the market. You're not going to see much of an increase in inventory, is my guess, unless they start popping houses out of the ground. And that's going to put the sellers back in a little bit more control because there's going to be more demand for less product. So as you start to strategize, what we want to do is take a look at how do we compromise taking advantage of the lower interest rates, but maybe still being slightly more aggressive on our offers. And that's where Mortgage Coach and Total Cost Analysis comes in. So we'll keep monitoring interest rates. I think you're going to see them kind of super ball back and forth here over the next couple months as the market and the economy and consumers try to find their ground. But you can start to see that when interest rates fall, it creates a significant savings for the buyer. And we can use that savings to strategize offers and help you be most attractive to the sellers. If you have any questions at all, you can reach out at andy.loan.com.